Hey, what's up, everybody? Welcome back to Passive Money. I'm Kirby. That's Alex over there. This video right here, I'm shouting out to my nephew, Velsoni. He called and hit me up and he said, "Hey, I need a video about why prices are so high." He's a teenager now. So he's starting to get some money, going out, doing this thing, just little small, adolescent things like going to get his own ice cream and stuff like that. So he wanted me to do a video about why prices are going up. So I'm just going to show this quick illustration on what causes price to go up, and it's simply based off the supply and demand. All right, so I'm gonna share my screen here. Can you see the screen,
Yep.
Alex?
Yep. Got it.
All right. So this simple economics 101. This is the supply curve, this is the demand curve. The supply 0 to infinity, demand is infinity to 0, right? And then the equilibrium where you see price at, or where you see the price of a certain uh product, no matter what it is, gas, housing, whatever, it's usually where the demand curve and the supply curve intersect. And what we have right now, and this is in a normal society, this is normal, where it's equilibrium on the supply side, is equilibrium on the demand side. Where they intersect, that is the price point of the best quality of price. Best quality, best price, that's where it's at. So what we have is, and so when demand goes this way, I'll put an arrow there, demand goes higher, and then demand curve do one of these numbers like this, the equilibrium price is higher. So if the supply is staying the same, in a perfect world, the supply is staying the same, and the demand is increasing, which of course we've seen demand increase a lot here, then the price of quality and the pricing and quality intersects here. So that's what drives the price higher. So when demand goes higher, when the Fed introduced more money into the economy, when people getting stimulus checks and things like that, which of course I know all that has surpassed and subsided. What happened is supply never increased and the demand did increase. So this is where equilibrium is at now, and this is why prices are higher. And that's simply why prices go higher. It's all about supply and demand. And then on the inverse, let me erase this here. On the inverse here, so I erased that there. So let's go on the inverse here. Let's say demand stayed constant, but then supply increased. The supply increased. So going this way, demand stayed constant, but the supply increased. So now the supply line is here. So now the new price point is lower. If it's more supply than demand, then the price will drop. If demand is staying constant, but they start producing more, let's say oil. If they start producing more oil, then the price of gasoline will drop if the demand stays the same. But if the demand stays the same, but then the demand stays the same, but then the supply drops, going this way, then the price goes higher. And we've seen this dynamic the whole time between, the COVID 2000 crash, the supply train dropped and the demand stayed constant and prices went higher. Then demand increased, then the supply was close to equilibrium, and then we saw the prices increase here and here. And that's the dynamic that we're in. The supply is not constant and demand is increasing, drawing up higher prices. The supply decreased, especially when COVID happened, but the demand stayed the same with all of the, extra money that the Fed was putting into the economy, and the supply wasn't there. So to put it at a quality price, a quality product and a quality price, then the price had to increase. And that's the dynamic, and that's the situation we're still in. We're still in low supply, high demand area. So the prices are higher than what they normally be. And even in a normal economy, and if you listen to the Fed, it says this all the time, normal inflation is 2.5 to 3% a year, but we've been getting 6, 7, 8% inflation because of those dynamics, demand increasing and supply decreasing. So now we're out of whack all over the place. That's why you hear the words of recessions coming up and things like that. And then the thing is, how do you get it back to equilibrium and back to a normal supply and demand curve? That's what you see the Fed doing now, making it harder for people to access capital. If they don't have the capital, then they can't drive up demand. So that's why they raising interest rates and things like that, and making people think more about the money that they're using, because it's going to cost them way more to pay it back. So hopefully what they want to do is stop people's demand for housing, demand for driving, demand for gas, demand for buying cars, demand for going and buying out the grocery store, like you see in a lot of places around the United States. They're trying to curb the demand and take money out of people's pockets, so they, paying more on debt and things like that, to take them out of buying up the supply chain, so the supply chain can correct itself and get back in a normal distribution. That's this right here, get back in a normal distribution, so we can get back to normalized pricing, which is right here. And this is a normal distribution demand supply curve, and this is where they're trying to get back to. But right now we're at a short supply, high demand area, so the price is up here somewhere, and this is way out of whack, and that's what's going on, and that's why prices go higher. And then you can, Alex, I'll let you speak on that if you have anything before I start talking crazy and going down the rabbit hole with it.
No, I don't have much. I was gonna talk on the oil thing, but you actually hit it. I've been noticing oil prices or gas prices dropping as well. Especially in now, what about for other states? I guess I could ask that. I've seen gas prices lower in, say Georgia, but gas prices are higher in Florida. Is that just state tax reasons, or is the economy?
Well, yeah, it's a lot of implications on that. First, it's a federal tax on gas, and then you can look it up on CNBC. It'll tell you the actual price of gas. It's called Rob gas. But the federal government has across the United States tax on gasoline, but every individual state has their own taxes, and it's different amounts. So let's just say, if all things being equal, if you're close to a refinery or something like that, or your demand is way lower, or refineries are closer to you, and it's less environmental dynamics to it, you're going to have lower prices. And if the tax rate in the state is lower, you're going to have lower tax prices. But the price of gas is the same across the United States. It's just, how much do it cost to get gas to that location? That can drive the price up. Regulatory effects, i.e. California is off the coast, so people thinking, well, California should have refineries and things like that, but the environmental or regulatory body that they have, make it harder to just, bring fuel and different things, no matter if it's come with truck drivers and the number of hours they can drive and stuff. But the cost, the input cost to get fuel to these locations determines a lot of factors also of how much gas will cost them. And then you add on the other things like federal and state taxes onto that also. So with all that being said, Velsoni, I did your video. I hope it educated you some, let you know what's going on, wondering why these prices are high. I hope your ice cream and snacks not going up too much, and we can weather the storm, but root for the Fed to raise the interest rates and bring down the demand so you can get stuff at a reasonable price. With that being said, love you, man. Have a good one. I'll talk to you later.
See you guys.